Breaking down all of today's market action, we have Mark Lucchini. He is Janney Montgomery Scott Chief Investment Strategist, who's going to tell us why he likes Europe over the U.S. right now. Charlie Smith, Fort Pitt Capital Group Principal and Chief Investment Officer, telling us what he thinks is the only sector out there that is actually worth your money right now. And Gary Kozlowski is joining us from the CME. Gary, I want to start with you. Why was the market kind of soft today?
Well, we had some real positive numbers this morning as soon as the jobless claims came out. Nobody really expected it to come down 11,000 the way that it did. Right now, what we're looking at, we're winding down the first quarter right now, so we're going to see things pulling back a little bit. We have the weekend, and then again, like I said, the end of the first quarter. And what we're looking at right now, there's a lot of uncertainty, and the volume levels are coming down. There's not as many traders in. A lot of people are out on spring break right now. And a couple of things that we'll be looking at tomorrow, we're going to be looking at personal income spending. We're going to be looking at the consumer sentiment. And one of the important things that really has been kind of off the radar a little bit is going to be the farm prices right now. I don't know if anybody's really noticed, but in the last 10 days, we've had 6 limit up on futures in hogs right now. And the price just keeps climbing and climbing and climbing. There's a concern about a PED virus, and there's a lot of feeling that they're not really reporting as many cases as are really out there. So there's a lot going on. Yes, yes. Bacon. Keep your eyes on bacon, folks. Sorry to hear that.
Food inflation.
It is a tourism.
It has been, you know, we can joke all day, but it's got serious implications for food inflation. You know, Mark, but we look at these markets, and you have to make some sense of this for us. We have a flat day in today's trading session. You look at the stock market so far this year, it's gone nowhere. But everybody seems to want to put their money to work. Where are you seeing opportunities right now?
Well, Sandy, as you mentioned early on, the market's flattish, but that doesn't mean it's indicative of what's going on all over the world. And in fact, some markets away from the United States, returns have been outstanding. We've advocated a position actually in the European area as a way to take advantage of a couple of things. One, that the European economy is growing, albeit at a very, very nascent pace at this juncture, but we think is showing continued signs of improvement. In fact, the aggregate PMI across the Eurozone are indicating a growth rate of approaching 2%, which for Europe is actually quite terrific. In addition to that, a lot of great companies sport valuations that are much cheaper than their U.S. counterparts. So the combination of better news coming out of Europe as well as the prospect for multiple expansion, we think means we'll see non-trivial returns from the euro area. So that's where we find good investment opportunities. And in fact, particularly in some of the peripheral countries, the returns year to date are not just positive, but are actually up double digits.
All right, Charlie, let's bring it home. And dare we use the word correction? Do you see a correction coming?
No, I would sort of echo Mark's comments about trivial returns for the U.S. this year. We see fair value on the S&P of about 1935, maybe 17 times $114 earnings number. Consensus earnings estimates for the U.S. S&P 500 are coming down. They fell about 4 percentage points during the first quarter alone. We expect that the consensus is going to continue to fall the rest of this year, and we'll end up the year at about $114 in earnings. 17 multiples, perfectly reasonable. You know, that's another 3% to the upside this year. Really not much to write home about.
Gary, you know, in all of this, we're watching gold. It actually fell and closed below $1,300 an ounce today. So on a day where the stock market was flat, you look elsewhere for where there was activity, and certainly that showed up in the gold market.
What I'm seeing in the gold market is, again, you got a lot of fun guys that are selling out right now. We're seeing the dollar slowly start to gain as the U.S. economy is trying to gain. So what we're seeing right now is just a little bit of a sell-off, but I think if it breaks the 1280, then we're in for a bigger fall-off. We'll see 1250. I don't think it's going to break it in the near future. I'm looking for it to get back up into the 1350, possibly get close to that 1391 range, which was the high earlier this month.
Mark, I understand your enthusiasm for the market and growth, and I believe in the U.S. economy and the perseverance of U.S. companies that could push equities higher. But a lot of people are, despite that, moving to some defensive sectors. Wouldn't you shift your portfolio to a bit more defensive right now?
You know, I'd be reluctant to do that. You know, we saw what happened last year when you had an uptick in interest rates. Granted, it was a rather violent one, but it was those defensive sectors that are more interest rate sensitive, generally speaking, that got absolutely pummeled. And in addition to that, because we think as a base case the U.S. economy is poised to accelerate in 2014 over last year's growth rate, we think that's going to benefit the more pro-cyclical stance.
But I'm just wondering, forgive me for interrupting, Mark, but isn't that what the market has already forecast? Hasn't that increase in growth already been cooked into these market numbers?
Well, in fact, I don't think that's the case. I think that actually was pulled into some of the returns for last year. And so far this year, because we haven't had that positive impulse from better than expected economic news, and we have fairly full valuations in the U.S. equity market, I think that cocktail is combined to really sort of make this market a trading range environment like we've experienced so far year to date. But I think we're going to see bleeding through the economic data coming forward, better news economically, and as a result, I think that's going to be what is actually transpiring into higher equity prices.
Charlie, what do you get excited about right now?
Domestic energy, there's a lot of capital flowing into gas gathering and pipelines. We think there's a big opportunity to put a lot of money to work there. It's very capital intensive, so names like Kinder Morgan, Chart Industries based in Cleveland, companies that build the infrastructure for the natural gas build out that's continuing.
Charlie, aren't you a little concerned about housing, right? We've got a housing guest coming up who says that the housing recovery is over a little later. What do you think about housing right now?
I would agree that housing has become a bit of a victim of its own success. We saw a 13% annualized rate of increase in Case-Shiller over the past year. So we've really lost the first-time buyers. The move-up market isn't there. The housing improvement really has been all about price instead of unit volume. And until we get higher volumes of homes being built at lower prices that people can afford, I think there's a good chance that the housing recovery really does peter out.
All right, Gary, I'm partial to commodities talk right now simply because that's where we're seeing the most action and the most money moving around with equities flat today. Looking at the oil market, what the heck is going on there? Oil prices keep climbing. They're back above $100 a barrel, but yet we had this extremely bearish oil report yesterday. So what gives in the energy market?
Well, what we're seeing is there's still a lot of talk now, and now that it is an election year, you're going to hear a lot more about that Keystone Pipeline. You know, it really does need to come into play, and of course, all the politicians that are up for election this year, they're going to use it to their advantage. It is something that we are going to see, but what we've seen lately is a lot of train accidents with petroleum. We're seeing the situation over in Europe and in Russia right now, and Russia exports a lot of their fuel and the natural gas over to Europe, so we're seeing those things just come into play right now. We're seeing the spread widen between Brent and crude oil right now. Yeah. So there's a lot, and the demand really isn't there here in the U.S. The refineries are down. They're having a tough time getting it into Cushing. As we saw yesterday, that was down 1.6 million barrels for the week. Yeah. But yet we had a build on the inventory.
Hey, they're giving me a wrap here, fellas, but I just have to go back to Mark Lucchini for a second because you have an anti-Russia energy play, GDF Suez. Very quickly, tell us why you like it.
French-based company, basically the largest energy infrastructure company in the world today, about a $66 billion market cap, and as well about a 5+% dividend yield. We think it's well positioned to take advantage of not only obviously elevated oil prices, but as well perhaps an energy build-out in the euro area.
There it is. GDFZY is the ticker symbol.
Thanks,
Thank you, guys. Mark Lucchini, Charlie Smith, Gary Kozlowski is going to be back in a couple of minutes when the S&P futures close. Appreciate it.